The safest place in America wasn't a street, it was a spreadsheet. Everyone believed audited numbers meant protection, stability, control. The mistake was microscopic, one formula trusted without question. No alarms, no masks, just signatures and silence. And when the numbers finally moved, there was nowhere left to stand.
The glow of a computer monitor in a quiet, air-conditioned office in Houston, Texas. It is late summer, 2001. Most of the building is empty, but a mid-level corporate executive is staring at a spreadsheet on her screen. She's looking at a column of numbers detailing a series of partnerships called the Raptors. These are side companies, separate from the main corporation, designed to hold assets. But as she traces the formulas from one cell to the next, a cold, sinking feeling begins to form in her stomach. The math is simple, but the implication is terrifying. Her company has been losing hundreds of millions of dollars on bad investments. To hide these losses, they have sold the bad assets to these Raptor partnerships. In exchange, the Raptors have given the company IOUs, effectively neutralizing the losses on paper. But as she looks closer at the spreadsheet, she asks a basic question. Who is funding the Raptors? Where is the real money coming from to back up these IOUs? She clicks through the cells. She traces the capital. And there it is. There is no outside money. The Raptors are funded entirely by her own company's stock. The company is hedging its own bets with its own money. It is an infinite loop of air. If the stock price ever drops, the Raptors will collapse, the hidden losses will bounce back onto the main balance sheet, and the entire corporation will instantly implode. She assumes she must be misunderstanding something. She is an accountant, but this company is filled with the smartest financial minds in the world. The world's top auditing firm has signed off on this. Dozens of high-powered Wall Street lawyers have approved it. She checks the math again. She looks around the empty office. She hasn't misunderstood anything. The smartest guys in the room aren't geniuses. They are running a deeply complex, highly sophisticated shell game, and she is holding the spreadsheet that proves it. We are culturally conditioned to think of major crimes as physical, violent, or shadowy. We picture masked men, secret offshore vaults, or back-alley handoffs. But the most destructive crimes of the modern era do not happen in the shadows. They happen in brightly lit conference rooms. They are built inside perfectly formatted Microsoft Excel files, bound in glossy annual reports, and celebrated on the covers of business magazines. The collapse of Enron remains the defining corporate crime of our time. But its true legacy isn't about the billions of dollars evaporated, or the thousands of jobs destroyed, or the criminal convictions of its top executives. It matters today because of what it reveals about human psychology, institutional momentum, and the terrifying ease with which a culture of silence can normalize deception. To understand how a $60 billion company turned out to be a mirage, you have to look past the dramatic arrests and the congressional hearings. You have to look at the small, incremental choices made by hundreds of ordinary people over a decade. You have to look at the pressure, the incentives, and the subtle, unspoken agreement to look the other way. By the late 1990s, Enron was not just a natural gas pipeline company. It was the future of American capitalism. It had transformed itself into a massive trading floor, buying and selling electricity, broadband internet bandwidth, and weather futures. They were innovators. They were disruptive. Their corporate slogan was literally, "Ask why." But inside the gleaming glass towers in Houston, the culture was fundamentally rooted in fear and relentless pressure. Enron operated on a deeply Darwinian employee review system known as the Performance Review Committee, or the PRC. Internally, it was called rank and yank. Every 6 months, employees were graded on a scale of 1 to 5. The top tier received massive bonuses, stock options, and sports cars. The bottom 15% were given 2 weeks to find another job within the company, or they were fired. This system created an environment of intense, paralyzing paranoia.
You did not collaborate with your coworkers. You competed against them.
You did not raise concerns about a project's viability because being labeled a pessimist could drop your PRC ranking and cost you your livelihood. The only thing that mattered was closing the deal and booking the revenue. And the way Enron booked its revenue was the first quiet step toward its doom. The company had adopted an accounting method called mark-to-market. In a traditional business, if you sign a 10-year contract to provide a service, you record the revenue year by year as the money actually comes in. It is slow, steady, and grounded in reality. Mark-to-market accounting is different. It allows a company to estimate the total future value of a long-term contract and book all of that estimated profit on the very first day. It is the financial equivalent of signing up for a marathon, estimating that you will finish in first place, and immediately putting the gold medal around your neck at the starting line. Initially, this allowed Enron to show explosive growth. Jeff Skilling, the company's brilliant, hyper-competitive president, championed this method. It rewarded intellectual purity over operational reality. You didn't actually have to build the power plant or lay the fiber optic cable to get the bonus. You just had to get the contract signed and project a massive future profit. But there was a fatal flaw in this system. If reality failed to match the projection, if a power plant in India was a disaster, or if the broadband market crashed, Enron was suddenly stuck with massive real-world losses. Because they had already booked the future profit, they now had to explain to Wall Street why the cash wasn't actually there. They needed a hiding place. Enter Andy Fastow, Enron's chief financial officer. Fastow was not a traditional cautious accountant. He was ambitious, aggressive, and desperate to impress Skilling and the company's chairman, Ken Lay. Fastow realized that Enron needed a way to sweep its massive losses under the rug to keep the stock price climbing. His solution was a series of special-purpose entities. These were essentially dummy corporations set up by Enron for the sole purpose of doing business with Enron. He gave them cinematic names: Jedi, Chuco, LJM, and the Raptors. The mechanics were deliberately complex, designed to look like high-level financial engineering. But at their core, they were simply a trash can for Enron's toxic assets. Whenever Enron had a bad investment dragging down its books, it would sell that investment to one of Fastow's entities. On paper, Enron looked incredibly healthy. Their losses were magically vanishing. Their quarterly earnings strictly met Wall Street's expectations. The stock price soared to over $90 a share. But the reality beneath the surface was absurd. Fastow was actually running these side entities himself. He was negotiating against his own employer and paying himself tens of millions of dollars in management fees to do it. The entities had no independent capital. They were propped up by guarantees of Enron stock. It was a house of cards built on its own reflection. This brings us back to August 2001 and the quiet executive staring at the spreadsheet. Her name was Sharon Watkins. She was a vice president of corporate development, tasked by Jeff Skilling to find assets Enron could sell off to raise cash. To do her job, Watkins had to map out the company's financial structures. When she opened the files on the Raptor entities, she was not looking for fraud, she was simply looking for the bottom line. What she found defied logic. She saw that Enron had essentially locked in its own stock price to insure itself against its own failures. It was a recursive loop of toxic debt. If Enron's stock price stayed high, the illusion held. But the moment the stock price began to drop, the Raptors would be unable to cover the losses. Those hidden losses would bleed back onto Enron's balance sheet, which would cause investors to panic, which would drive the stock price down further, which would trigger even more losses.
It was a mathematical death spiral waiting for a single push. Watkins was paralyzed. The sheer scale of the deception was incomprehensible. This wasn't a minor accounting error. It was an existential threat embedded in the company's DNA. But what is most fascinating and most unsettling about Watkins's discovery is her immediate psychological reaction. She did not immediately assume her bosses were masterminds of a criminal conspiracy. Her first assumption was that she must be missing something.
How could it be a fraud? Arthur Andersen, one of the big 5 accounting firms in the world, had auditors stationed permanently inside the Enron building. They signed off on every single transaction. Vinson and Elkins, a prestigious law firm, drafted the legal documents. Wall Street analysts from Merrill Lynch, Citigroup, and Chase Manhattan consistently issued strong buy ratings on Enron stock. The most disturbing hidden mechanic of the Enron fraud is that the gatekeepers were entirely compromised. Arthur Andersen was being paid roughly $25 million a year to audit Enron's books, but they were being paid another $27 million a year in consulting fees to help Enron design the very financial structures they were supposed to be auditing. The referee was on the payroll of the team they were officiating. If an Andersen auditor raised a red flag, Enron executives would call Andersen's partners and threaten to pull the $50 million account. The auditor would be quietly reassigned. The red flag would disappear. Wall Street banks played the same game. Enron was one of the biggest clients in the world, generating massive fees for the banks that helped underwrite their deals. If a bank analyst wrote a skeptical report about Enron's opaque financials, Enron would freeze that bank out of future deals. The pressure would come down from the bank's executives, and the skeptical analyst would be replaced by someone more cooperative. The fraud did not require a massive coordinated conspiracy. It only required a system where everyone's paycheck depended on not asking the obvious question. It was a diffusion of responsibility. The lawyers assumed the accountants had checked the math. The accountants assumed the lawyers had checked the legality. The bankers assumed the executives knew what they were doing. Everyone chose to accept complexity as a substitute for reality. On August 14, 2001, Jeff Skilling, the architect of Enron's culture, abruptly resigned as CEO, citing personal reasons. The stock had already begun a slow slide from its peak, hovering around $40 a share. For Sharon Watkins, Skilling's sudden exit was the final alarm bell. She knew the death spiral was beginning. She drafted an anonymous memo and dropped it into an internal suggestion box. It began with a chillingly accurate prediction. "I am incredibly nervous that we will implode in a wave of accounting scandals." A week later, she met directly with Ken Lay, the founder and chairman who had returned to the CEO role. She handed him a detailed document outlining the catastrophic math of the Raptors. She explicitly warned him not to involve the lawyers at Vinson and Elkins to investigate because they had helped draft the deals and would only protect themselves. Ken Lay nodded, thanked her for her concern, and immediately hired Vinson and Elkins to investigate the deals. The law firm conducted a brief, shallow review. They interviewed a few executives, did not dive into the underlying math of the accounting, and concluded that while the optics were bad, no further investigation was necessary. Lay assured employees and investors that the company was fundamentally strong. He encouraged them to buy more stock. But the math could no longer be contained. As the dot-com bubble burst and the broader market softened, Enron's stock price slipped. The Raptors began to fail. In October 2001, Enron shocked the financial world by announcing a massive third-quarter loss of over $600 million and an inexplicable $1.2 billion reduction in shareholder equity. The market panicked. The financial press, which had spent years calling Enron the most innovative company in America, suddenly woke up. Reporters and SEC investigators began asking the simple questions they should have asked years earlier. How exactly do you make your money? What is in these side partnerships? Enron had no answers.
Inside the company, panic set in. On the auditing floor, Arthur Andersen partners suddenly realized their exposure. In a desperate attempt to cover their tracks, they initiated a massive shredding campaign. For days, the shredders in the Enron building ran constantly, destroying thousands of documents and emails. But you cannot shred a mathematical inevitability. The death spiral Watkins had seen in the spreadsheet accelerated with terrifying speed.
In a matter of weeks, the stock price plummeted from $40 to $20 to $10 to pennies. Credit rating agencies downgraded Enron to junk status, triggering clauses in their contracts that required them to instantly pay back billions of dollars in debt. They had no cash. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. It was, at the time, the largest corporate bankruptcy in American history. 20,000 employees lost their jobs and their health care. Worse, because Enron had actively encouraged and in some cases restricted employees to hold their retirement savings in company stock, thousands of ordinary people lost their entire life savings. The executives at the top, meanwhile, had quietly cashed out hundreds of millions of dollars in stock before the collapse. The popular story of Enron, the one cemented in the public consciousness, is a story of a few evil masterminds. It is comforting to believe that Jeff Skilling, Andy Fastow, and Ken Lay were simply bad actors who hijacked a good system. It is comforting to believe that once they were caught, indicted, and sent to prison, the system was purged. But the uncomfortable reality beneath the Enron collapse is that the system wasn't hijacked. The system functioned exactly as it was designed to. Enron exposed the terrifying fragility of the modern financial ecosystem. It showed that when enough money is at stake, the gatekeepers will fail. Auditors will look past blatant conflicts of interest. Regulators will defer to industry experts. Employees will ignore their own moral compasses to survive a brutal corporate culture. No one wakes up and decides to build a $60 billion fraud. They decide to hide a small loss for one quarter just to get by. They decide to use a legally gray accounting trick to hit a bonus target. They decide not to ask a question in a meeting because they don't want to look stupid. The deception is not a sudden explosion. It is a slow, creeping rot, justified step by brilliant people who convince themselves they are simply outsmarting the rules. Today, the names have changed, but the underlying mechanisms remain untouched. We see it in the catastrophic implosion of cryptocurrency exchanges, where billions of dollars of customer funds vanish into complex digital ledgers. We see it in the wild valuations of tech startups built on aggressive projections and non-existent profits. We see it whenever a charismatic founder promises to disrupt a traditional industry using financial alchemy that nobody fully understands. The math is always the same, only the scale of the spreadsheets has grown. When you zoom out from the Enron disaster, you are left with a chilling perspective on human nature. We are highly rationalizing creatures. If our salary, our status, and our identity depend on believing an illusion, we will not only believe it, we will aggressively defend it against reality. We will build incredibly sophisticated structures to protect our blind spots. Sharon Watkins wasn't the only person who saw the numbers. She was just the one who stopped assuming someone else was going to fix it. Dozens, perhaps hundreds of highly educated professionals saw pieces of the Raptor spreadsheets. They saw the circular logic. They felt the same knot in their stomachs. And then they closed the file, turned off their monitors, and went home. The haunting question left by the collapse of Enron isn't how it happened then. It is where it is happening right now. Somewhere in a brightly lit office, a cursor is blinking on a cell. The math relies on an impossible assumption. The numbers are a loop of air, and someone is looking directly at it, weighing their conscience against their career, and deciding to remain silent.